And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. As always here, now money's been pouring into ETF funds this year. We know that. Plain vanilla ETFs getting enormous amounts of money coming into them. But now we're seeing something potentially new and different. Let's talk about that. Over the weekend, Dimensional Fund Advisors has converted 4 of their mutual funds into ETFs in the largest ever conversion from mutual funds to ETFs to date. Let's talk to Dimensional Fund CEO Gerard O'Reilly and Dave Noddick, Chief Investment Officer at ETF Trends. And Gerard, you're the mastermind behind that. You're talking about nearly $30 billion in mutual funds, 4 of your mutual funds converting into ETFs. Just briefly explain the rationale behind doing this, because this is the biggest one that's happened to date, and potentially you're going to be a leader doing this.
Yeah, thanks, Bob. It certainly was a big weekend for us. We're very excited about the conversion over the weekend. When you look at these 4 mutual funds, Bob, they have a long and strong track record. They go back almost 20 years, some of the mutual funds that we converted. And they were all managed with an eye towards tax management. So they have tax management in the name, and tax efficiency is part of their objectives. And so what that means is that the investors in these strategies, think about after-tax returns, think about tax efficiency. And so while they've done a very good job in terms of maintaining high tax efficiency ratios, in fact, similar to many ETFs out there, this ETF wrapper gives us an additional tool to help achieve the investment objectives and increase the tax efficiency ratios of these strategies. So that was a big driver behind why to convert these mutual funds to ETFs, Bob.
You know, Dave, Gerard likes to say he's wrapper neutral. In other words, he manages money, and if it's in an ETF, fine, a mutual fund, fine, whatever. But we're interested in the ETF business, covering that. And Citigroup had a great report out last week saying dimensional conversion of the mutual funds into ETFs will provide some kind of benchmark for having this happen in the future. I'm wondering what your thoughts here. Will it push a lot more of the mutual fund industry? It's 21 trillion, something like that, into the ETF. Is this going to be another accelerant?
I think it has to be, right? I mean, first of all, congratulations, right? I mean, I think it's a monumental day to see this large a conversion. But I think we have to recognize this is a fairly narrow product set. These aren't funds that are in 401ks. That would make it much more difficult. They're not actively managed funds that really rely on non-transparency. That's a whole nother discussion. So there's a bit of a Venn diagram overlap where I think these funds are in a real sweet spot for conversion. They're also funds that now investors can get access to. I mean, historically, it's been a little tough to get access to some dimensional funds unless you had a dimensional approved advisor who could help you do that. Now anybody can get access to these, what are great strategies, very, very tightly managed strategies, great trading under the hood. So I think it's a great sign, but I'm a little skeptical that somehow $1 trillion is going to follow suit. We know that a lot of active managers like to keep their trading private. There are different structures for that. And a lot of the mutual fund industry is very focused on the 401k industry, and that makes conversions really difficult.
Yeah, well, but what about that, Gerard? I mean, you've been very successful. I look at the money flowing into some of these that are already out there that you've had, the 3 or so you've already had out there that are in ETF space. You've attracted a lot of money. That's very attractive to get people out there who might not have been in your mutual funds before or qualified or had a platform, as Dave mentions, to go in there. The ETF wrapper, besides the tax advantages, does have that advantage. You can bring in a lot more people, potentially.
Yeah, Dave hit on a couple of great points. And one of those points is that when you look at that Venn diagram that he mentions, where these funds are managed with an eye towards tax management, when you think about Dimensional's approach to investing, it has a lot of benefits of indexing. You know, it's low cost, you have broad diversification, low turnover, but then a lot of the benefits of an active implementation, whether it's the trading under the hood, consistent focus on the asset category. So a lot of those things put us in a real sweet spot, and these funds in particular in a real sweet spot to have this conversion kind of go through successfully and make a lot of sense for the shareholders in the strategies. I do think that when you look at the ETF landscape out there, it's 99% index approaches on the equity side. And what this brings and offers investors is a systematically managed strategy that you can observe its live track record for some of them over 20 years in all types of market environments. And I think that's somewhat unique to the industry. So we're very excited about being able to offer this, and in that kind of tax-efficient wrapper, which will, I think, benefit the investors in those funds. And in particular because, there's a lot of talk and concern about what might happen to tax rates going forward. So for those folks that are kind of thinking about that, tax management can be important.
I want to drag, Gerard, you into the whole value versus growth debate and small cap versus big cap. Dave, I want your thoughts on this as well. But, Dimensional has always been associated with low cost, but value investing in general. And I wonder if you could comment on what's been going on this year. What we've seen is, for the first time in a long time, for many years, 6, 7 years, value has outperformed growth. Small caps have outperformed big caps, and small cap value has outperformed everything. This hasn't happened in a long time. Growth is generally outperforming rather notably. Why is this happening? Do you think it's going to continue? Obviously, I'm sure you're happy about that, but just comment on what we've been seeing this year.
Yeah, a couple of high-level comments come to mind, Bob. First off, when you think about small and value, there's a reason those stocks have lower prices and investors demand higher returns in terms of holding them. So every day when we come into the office, we expect a positive small and value premium. And we've certainly seen that in spades over the course of the year. Even if you go back 12 months, Bob, and you look at Fama French, large growth versus small value, kind of a very pure, I guess I call it, definition of large growth and small value. The return differential is almost 60 percentage points. So a really big return difference, and something we expect a positive premium, but not always that large. The other thing I'd put out there that I think is important is that when you look at the volatility that we've had over the past few years, it highlights the importance of the financial professional in keeping you disciplined, and a money manager who stays focused on the asset category. Those two in combination make a powerful combination for the end investor. We're fully committed to the financial professional, and we think that these new, the ETF conversion will give them more tools to help manage for their clients. And we stay focused on those asset categories so that when those big returns show up, we're there to capture them. And I think that that's something that we've seen year to date and over the past 12 months.
Dave, weigh in on this. I just put up a board of growth versus value in the last 6 years, and it's a notable outperformance by growth. Why are investors paying so much money for growth in the last few years over value? This year, we're seeing a little bit of a mean reversion, as Gerard mentions. But your read on what an investor is supposed to take away from the last 5 or 6 years of growth outperformance?
Yeah, I think a lot of it has been flow driven, right, Bob? I mean, we've seen the flows that have come into cap weighted traditional ETFs. That has a quality of making the large cap market look very momentum-y. We already know that a lot of the growth companies have historically been at the top of the cap spectrum really since the dot-com era. So there's a bit of a winner take all scenario here. Interestingly, the flip that we've seen where some of the small cap or mid cap value plays have started to catch investor attention means a lot of those individual stocks are now showing up in momentum ETFs and funds. That's going to really change the dynamics here. I don't think we talk about value momentum all that often, but if you look at some of the bigger traditional momentum funds, that's what you're seeing. So I think we are in a bit of a rotation. A lot of it's because there's a no alternative market, right? Investors and advisors are really sticking to the equity markets. They don't want to move into bonds. That means they're looking a little bit away from some of these large cap go growth companies like the Teslas and Amazons of the world, down the cap spectrum into mid and small caps, into a little bit more traditionally valued companies, even a little like for dividends. So I think that's a bit of a risk-off rotation while staying in equity, which is a bit of an oxymoron, right? We don't talk about small cap being a risk-off rotation, but I think that's some of what we're seeing.
Yeah, Gerard, we are seeing the rather bizarre spectacle. I think we talked about this on the phone last week about GameStop and AMC are in the Russell 2000 value index. And of course, they've completely blown up in the last year. I don't know, they're certainly not value stocks. They won't be anymore. But you do have that rather strange situation. I just want to go back to this growth thing, because this is the thing the investors really keep hitting me on and asking me about how much longer is growth going to outperform. But Why is the question? And a lot of comments I get around the Federal Reserve that there really is a Fed put, that growth is hard to come by. The Fed has made it very easy, essentially, to own riskier assets because there is a Fed put, because they're out there buying constantly. Isn't that a factor? I know you can't say, oh, we're up 200% since 2009 because half of it's because of the Federal Reserve. You can't quantify it, but isn't there something to be said about the Fed helping out the whole market, and particularly the growth market?
Bob, I think the Fed is certainly one market player and one market participant among many. And I think one question that's an important question for the investor is, should you expect large growth to be a 20% asset category? And if you look back over the 10 years ending last June, and you were looking at large growth in the US, it was about 20% returns, when its long pull return had been around 10%. So I think that the takeaway that I would take from that is that some of those returns were largely unexpected. And that's important to keep in mind, because when you're investing based on expectation. And if something is unexpected, it doesn't mean that the expected return of growth stocks going forward is 20%. It means they got unexpectedly lucky or unexpectedly good windfall, which may be because of the Fed or maybe because of other reasons. So I think that's really an important takeaway, Bob, when you look at the past data. Do you think large growth is a 20% asset category? And most people would say probably no. When you look at small value, does it return to its long-run average returns, which are more in the 14-15% asset category? I think most people would say, yeah, that's plausible, given the types of stocks that you have in small value portfolios.
Yeah, Dave, you're more willing to sort of stick your neck out on these things. Is it fair to say that the growth has been helped by the Federal Reserve? I keep pounding on this, but it's the thing investors keep asking me. What happens if the Fed withdraws that liquidity? Does that mean that growth no longer will outperform?
Yeah, I mean, it's a combo platter, right? Yes, we have the sort of the Fed put, if you will, but at the same time, we have a bond market that's really unattractive. And I think we have to look at that. And with that unattractive bond market, that means people are making blanket allocations to equities. When they do that, they tend to use cap-weighted large cap indexes, very cheap beta. What that has a tendency to do is really reinforce this winner-take-all market, and it pushes those large cap growth companies even higher. And I don't really see a way that unwinds unless we start getting a lot of really thoughtful reallocation. And honestly, we haven't seen that kind of thoughtful reallocation, right? So there is this endless bid in the market that I think is hard to get away from.
Yeah. Gerard, let me just change things a little bit. You are very big on managing accounts for tax efficiency, which makes a lot of sense. It always amazes me how many people try to get 4 basis points out of changing ETFs and don't care about the tax situation that they're encountering. And that always amazes me, and I laud you for being concerned about that. I wonder if you can get your take on the Biden administration's plan to hike capital gains, corporate taxes, and personal income taxes. What are I know you're not a handicapper for politics, but what are you telling your clients now about that prospect?
I think there's 2 big things that are important when you consider what future tax code may look like. One is, what will the market's response be? And if the market perceives that something will lower future cash flows to investors or increase discount rates, that will have an impact on prices. And whatever the market already expects is already in the price. So the price is forward looking. Don't worry about it, move on. The second is, control what you can control. And when it comes to taxes, you've got to look at whatever the tax code is at that point in time, and then make sure you have the flexibility to be able to maximize after-tax returns. And that happens both inside the fund or the ETF or a separately managed account, and also at the end client level. So there's a lot that you can do to help maximize your after-tax returns, whether it's how you manage dividends, whether it's how you rebalance, as you mentioned, Bob, you sell from one fund into another and realize a large capital gain, or the types of distributions that you get from funds. So control what you can control, and I think a flexible approach allows you to adapt to changing tax code over time to make sure that whatever the tax code is, you make the most of it as an investor.
Yeah. Dave, I get that this is not going to necessarily create an avalanche of conversions from mutual funds into ETFs, but I'm wondering about your take on the 401k system. I've been waiting for 10 years for even small cracks to occur and make it a little easier to own ETFs in the 401k situation. Where are we on that? Just give us a brief update.
Yeah, so there are a few record keepers, some small, some large, that do have ETFs in 401k plans. Generally, you kind of have to decide that when you're setting the 401k plan up. So that doesn't help most of us who are already working for a company that already has a 401k plan in place. 401k plans don't change record keepers very often. It's a huge pain in the neck. And so because of that, we haven't seen a lot of innovation in the 401k record keeping space. Plus, let's be honest, right? The mutual fund industry is in the 401k industry partially because they can fund record keeping through 12b1 fees. And that's something that most ETFs just don't have to offer. So to put a 10, 20 basis point ETF in a 401k means somewhere in the system you've got to pay for that record keeping and education and statements and all that jazz that goes along with running an ERISA approved retirement plan. So what we really need is a restructure of how corporations think about funding these plans, how they think about managing these plans, and honestly, we just haven't seen it. Some cracks in the system. Folks like Schwab have done a lot of really interesting work around it, but so far, not a ton of uptake.
Yeah, that's a separate topic, Dave, and a very important topic. Low-cost funds may not necessarily be feasible the way they're currently set up, at least in the 401k plan. It's a great point, Dave. I'm going to have to leave it there, folks. A fascinating discussion, and we'll have Dave back to talk about that 401k, maybe rethinking the 401k. That does it, though, for this week's ETF Edge. My thanks to Gerard and Dave. Now, we've asked Gerard to stick around and chat for just a couple of more minutes on our ETF Edge podcast, get his thoughts on the future. And remember, you can see all the shows that we have in our entire history of our show, the last several years, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.